This is Justin Pulitzer. This is my weekend review for Sunday, February 7th, 2016. Happy Super Bowl Sunday. The futures aren't open yet while I'm recording this, so I don't have the kind of the tip of the hat to look at that and kind of, I wouldn't say bias my review here, but it would maybe put a little bit more context on what I could think for the Monday open. China is closed for Lunar New Year this week, so that could be a little bit dicey in terms of the Asian markets not having any impact on the U.S. However, there was a North Korean long-distance missile test. I know when they had the nuclear test, it didn't go over well with the markets. We'll have to see if that's a factor. That broke right before the debates last night, on a Saturday, so we'll see how much panic that gets into the market. I like to start off the videos, though, talking about the Fed keys, because that's really what's been driving a lot of the action in the market, and then also the market keys. So I'll discuss the Fed ones for a little bit here. We had an NFP number, the non-farm payroll number, on Friday, and it was a miss. The media, for some reason, seemed to be in love with this number, that it was great, it's still strong enough to keep the Fed possibly in the picture. I think the chance of a March rate hike before the NFP was 10%, and now it was maybe 12% afterward. So it doesn't seem very likely that the Fed is going to continue going in March, although these dunderheads over there seem to keep talking it up and saying that the meeting is live, and the market doesn't really like that. Anyway, the jobs number was quite weak. I don't really care what the TV peeps were talking about. The number was a miss. A lot of temporary hires. They were talking about there being an uptick in hourly wages. I think that's really just because of minimum wage basically starting to go up. Walmart got that party started last year, and I think that's sort of been what's upticking here. These are not high quality jobs. All we see all day when we turn on the TV is oil and exploration type of companies laying people off. Even Yahoo is laying off a huge percentage of their workforce. It takes a lot of small businesses, and it takes a lot of waiter and waitresses jobs to make up for tens of thousands of jobs that are coming out of these sectors, and a lot of these jobs are quite high paying, particularly out of those shale type of country. So the jobs the picture is not good. I believe it is quite bleak. The GDP estimate, I know, was raised after that came out by the Atlanta Fed, but these guys have been all over the place, raising and lowering, and the number that they're at is basically still really stall speed. I think they were at 0.7, and I think they're now at 1.1. I mean, that's a pretty big jump in terms of Fed terms, but to have growth of 1.1, I mean, it's pretty pathetic. When I talk about the bonds, I think we'll circle back to that in a little bit. But GDP is quite weak. We know globally it is not well. The ISM came out this week. The trend has been down. The number was really quite weak. The manufacturing and the service numbers have been really quite egregious. And, we're supposed to be a service economy. A lot of people have been trying to poo-poo the manufacturing number, but the service number has been, just disgusting. PMI, another horror show. Durable goods, we know, are not good. I discussed last week about Boeing. Durable goods, the key kind of numbers that have been holding them up have been the planes, the autos, and the housing. The planes, we know that Boeing cut half of their production in the 747s, as well as some various other productions. That's not good. The autos have just not been able to get out of their own way. GM weak, Ford weak. The Ferrari IPO is just a complete debacle. Even Tesla getting creamed. It's coming down to a channel low here, so we might have a little bit of a bounce coming up soon. This is kind of a do or die level against the 78.6 and this channel low, so I think that could set up for some type of a row for some type of a snapback, maybe to the prior breakdown level here of the 195, but this is still showing some weakness. You basically had, I wouldn't quite call it an exact double top, but a slightly lower high. We've now snapped the pivot in between there, so these stocks are not showing a lot of strength. These are all auto stocks, so not a good sign. And then there's, of course, the market, but we'll get into that in a little bit. I wouldn't say it was sometimes you'd think it is the most important Fed input, But based on what the Fed has said, I believe that they have a number in mind in terms of their max tolerance for a down move before they will kind of back off and reverse policy. Unfortunately, I think we are potentially only halfway there. Yep, we're living on a prayer. We'll get to that in a little bit, though. For right now, with the VIX, I drew a key in. A lot of people were asking for it. You got it. I made a couple of little adjustments here. 0 to 15, you could really even say maybe even 0 to 17, but 0 to 15 for sure is purely directional play, long or short, meaning you would buy or sell calls or spreads outright. You don't really want to be short premium there. When you start getting to 18, 19, you could probably start selling some premium. You really want to do that when it's elevated into these levels. But if we start getting above 25, I've mentioned that, 25 and 31, that's really when the crash risk happened. You could see on this Friday here, right before the flash crash, the VIX took out the 25-20 with some quite strong authority. It closed basically near the highs, and then on that Monday, the market it basically just opened up a can of whoop ass, and the market, this was the down 1,400 point day. Yeah, the volatility backed off quite considerably after then, but there was a little bit of chop. But the point that I'm making is that we're sort of transitioning from a period of lower highs and more suppressed volatility to a period now of some more higher lows and higher highs with rising volatility. So we're going to have to see how that plays out. That could get a little bit dicey for the market if this channel kind of holds with the higher lows and the higher highs. Because IV, I mean, yes, it can spike on up moves. It's rare, but this is usually kind of the fear gauge, meaning when people are buying puts, they're sort of loading up on the protection. The good news is that Friday, I mean, we did hold the 50 this week, but we didn't close above the 25-20 or even 25. So this kind of closed up near these highs, so it's sort of into a little bit of resistance. And I guess that is one piece of solace that the down move on Friday did not take this out. It also didn't take out the Fed day low, so we'll talk about that when we get to there. We're not quite there just yet. The bonds. So there's good news and there's bad news. So there is an inverse relationship between the stock market and interest rates, yields. So as yields go down, meaning as bonds rise, stock PE multiple should benefit, meaning that stocks are valued on a discounted cash flow basis. I don't want to get too... if you're interested, Google DCF analysis or discounted cash flows. The risk-free rate is part of what's known as the hurdle rate, which is just basically the rate that is discounted. Think of it as a... let's just do basic math. Numerators and denominators. If the denominator is higher, your end product is lower. So think of interest rates as a component of the numerator. As part of the denominator, the bottom number. So if interest rates are going down, meaning bond prices are going up, that end product that is stock price is higher. If this is going down, meaning bond prices are falling and their yields are rising, then the end product should theoretically be lower. So why has the market been going down if bonds are going up? The answer is this. If you go back and you take a look at, it's sort of the way we've been getting there and why we've been getting there. If you look at the price of bonds, this was the 2009, the end of the world, right? 123.15 was the high. We are comfortably above there. And we've only really seen these levels when we've been in crisis mode. This was the kind of the right at the debt ceiling fiasco. We had this big run up again, and then again here in 14. I think the reason for this was basically that I think what's really kept this high for quite some time is that other countries, meaning the European banks like think Deutsche Bank, there's no FDIC insurance there. Like the ECB doesn't really kind of back your accounts like they do, the FDIC does in the United States. And I think when people get worried, they don't really think about a return on their capital. They think a return of their capital. We also know that the dollar has been quite strong. So it's not like these people are going to be buying bonds. And by the way, they have to sell their currencies. Think about what's been going on in Asian and foreign currencies, European currencies, and buy the dollar. And we all know the dollar has been strong. I'll get to that in a minute. And they can buy treasury bonds. So they have a pretty nice store of value, meaning that bonds have been strong and the dollars that they buy them in are strong. Like if the dollar was to start weakening here, people who hold these accounts would have to discount them for a weakening, for a weakening dollar. So they're actually able to mark these up because the dollar has been strengthening and the price has been appreciating. So this has sort of been a win-win trade for these wealthy people, I guess foreigners. Anyway, the not to get too off track with that analysis, but this has come up, and it's come up for the wrong reasons. It hasn't been on the Fed; it has been on fear of I believe, a recession, and that is really evidenced in a stock like Con Edison. This stock is basically trading between a 3 and 4% yield, closer to 4%. And is trading at almost 20 times earnings. This is like 19 and change. If you contrast that with Google, Con Ed obviously doesn't have really any growth, but if you contrast that with Google, that's only trading at like 30 times current earnings, and would be basically a very similar PE multiple, and that we know Google is growing at a similar PE multiple as Con Edison. That is crazy town, and the only way that is happening is because people are afraid of recession. These are the kind of stocks that do well. They look for bond proxies like this Realty Income. This is up at an all-time high. You can see it's had these types of spike and inflection points before, and this is just because people need a relatively safe place to kind of store cash to get a return, to get returns. Anyway, I don't want to get too off track, but I assure you that this is what the market is thinking. The other factors that the market factors in, kind of has been discounting is oil. I haven't really loved this USO chart, so I'm going to use some executive privilege here to zoom in on the oil via CL. So the reference lows, the 2009 crash low, remember the end of the world was 33.20. We are below there. We've tried to look above. We're kind of just consolidating. I really think that I'm not really sure the order of operations here. I've been quite surprised at the weakness in oil. Although I guess all of the technology that we've had, the advances here in horizontal drilling and hydraulic fracturing have really weighed on the price of oil. You've had a lot of companies, these kind of weak companies, take out tons of debt, and as the price of oil has come down, they've been under some financial pressure. The problem is if you have to make debt payments and have obligations to operate your business, you can't just stop pumping oil. So this has kind of been becoming a self-fulfilling prophecy. As the price of oil has come down, these companies have had to pump more and more and more, further suppressing the price of oil, but to meet their obligations. I've given the example of the mouse in a bell in the last couple of weeks. I don't really want to repeat that, but if you are curious, just Google the mouse in the bell experiment and, just substitute the oxygen for oil. But as this, stays weak, it can cause some problems with debt in these companies, and that's, been evidenced in some of the master limited partnerships and some of the, I guess, the more speculative oil companies. So weakness in oil, I believe. There's also a demand issue. China is slowing. The rest of the world is slowing. The U.S. is slowing. I think that the Saudis have been also making a play for market share. They've been pumping more and more. We know the Iranian oil is coming online. I guess the world is currently awash in oil. One of the things that let me think that we're getting kind of to I wouldn't say we can't go lower in terms of price, but maybe we're kind of getting to the end of this sort of cycle, is that when the S&P futures kind of key off of oil, that's sort of getting close to the end of a move. It did this at the top when oil was really, 147 or 114 a couple of years ago. it was very tied. As oil went up, the market was suffering, and now as oil goes down, the market is suffering. That's crazy, right? Consumers should benefit from lower oil, but the problem is that oil is being used as a proxy for global growth. A lot of oil is part of the GDP, and as the price of oil comes down, it is immediately reflected into the gross domestic product of the country. Longer term, yes, it will be phenomenal for consumers. It will also be great for Asia and Europe, who don't have the type of oil assets we have in the United States, and they will benefit tremendously in terms of their growth from lower energy prices. I believe that a lot of their woes over the last few years has been the stubborn high price of energy with weak economies, and it has crippled these countries' economies. They will be the beneficiaries from this, but it doesn't happen right away. What does happen right away, though, is the immediate effect on GDP, and that is hurting us here. So that is the oil. China. Gotta have your China. Wow, what weakness. They had the breakdown, the kind of stutter step, the breakdown, the check back here, and now further weakness. We're basically to a reference level here. Let me go back on a longer term chart. These 15 years have seemed to be serving us well, so let's stick with it. We are currently at an important reference level. We basically filled up the triangle from this trend snap. It's kind of do or die time here, or I think we will retest these 22s and potentially the 19s. I assure you, if this does snap, this will not be pretty for the U.S. market. It won't be pretty for any market. It will just be fugly. It is possible, though. I don't always assume, a lot of people always assume end ranges. I don't really play that. I always assume that support should hold. If they don't, that is more telling. We kind of stopped just shy of there. We're just kind of consolidating here. We know that China is closed for Lunar New Year, so there might not be that much action in this until that they kind of reopen. We've also known that in the past few years that Lunar New Year really does slow down the global economy because China is basically shut down for business, and they're already not buying that many of our commodities like oil, so they might be slower for longer. Some of the Chinese stocks that I get asked about a lot are, let's just go right to the elephant in the room, which is Alibaba. This had a low, quite a strong rally, a break of trend. It basically got into the high volume node here, came down, started forming some poor highs. This is a bullish pattern that should have resolved up. It resolved down. Now you have this overhead supply from all these people, and now all these people, and we're coming back down. It did hold the backside of the old downtrend line. I think a lot of the weakness, though, in BABA, yes, a lot of it is Chinese weakness, but I think a lot of it is the Yahoo overhang. We know they're trying to put themselves up for sale. We still know they have their shares to sell, and I guess that's probably going to be coming to market. So you have a big seller looming, and I guess people don't want to be in front of that. So, yeah, that's the story with BABA. BIDU, also kind of suffering. It's good that it's coming down ahead of the number. I'll tell you, if we can keep coming down. I have a couple of Fibonacci retracement levels drawn in here. I'm sorry, I have a bunch, right? I don't mean to have so many drawn in, but I do. We are coming close to 100% retracement of this move. We're at a 61%. This is basically the pullback low, the 100% retracement, and then from the flash crash low, we have a 61.8. So this is an important level. I think the more important level would be is if this could keep coming down ahead of the earnings and basically be back to the pullback level and a trend line touch. I think that would set up for, in my view, a right or right out long. And obviously, if that failed, it could get crushed back down to 100. But I think that considering this has been down for so long, so protracted, the stochastics are so bombed out that it could set up for some type of a right or right out play for a bounce at the very least. If it bounces ahead of time, the play then to me would be a move, maybe a short for a move lower. We'll have to see how with the kind of the order of operations. Obviously, the weaker into the number, the safer it is to try to play for a bounce play. The other main risk gauge of the last few years has been biotech. And you can see we have just, even with the flash crash, the check back, it's still a respected trend. We finally have broken trend. And when you break trend, it's not usually very pretty. We are back down to some, getting down to some reference lows around this 247, 250-ish. We're basically there. It wouldn't surprise me to see if this went a smidgen lower and then, kind of maybe respected these lows. It's also possible it does a full, check back here. I drew in a 1.618 Fibonacci projection basically from this high, from I think this low, and brought it down, and that basically takes you to the 100% retracement. So I like put ratios for a move down there, or put spreads on rallies. I don't like to put the put spreads on. When I'm long, basically long premium, I don't like to do that into weakness. If it's put ratios, I love to do that into weakness because you're net short of options. It really wouldn't surprise me to see some type of a check back to retest this breakdown. Usually when long-term trends break, there's a throwback and then usually either continuation or a move back up. So I would be very eager to short this backside of this trend line, particularly if it coincided with a couple of these moving averages like the 50 and the 100. Some of the problems have been evident in the way that these stocks, the big stocks like the Gileads, have been reporting. I think a lot of the weakness in this has been ETF driven, just a lot of people who've bought the ETF and they're selling and it's weighing on the components. There's a ton of political risk. Obviously, Hillary Clinton and Bernie Sanders and even Donald Trump have been, and these are all the front runners for the presidential nomination, have been basically talking about cutting drug prices. That means hurt margins, meaning these guys get lower money. We have a trend break in Gilead. We're basically kind of just kissing the breakout point. These guys had some pretty good numbers. Their earnings and the stock really couldn't rally. It had a very hard time, basically a tiny little bit, and now we're kind of basically back to there or below there. So these stocks really kind of have to get out of their own way before we can see some real rally in the biotech. Same thing here. We had a big kind of long-term accumulation funnel. That is now breaking to the downside. It's not super-duper convincing yet, although you did have a look below here, a move back up, and now you're below those lows, getting close to these flash crash lows. So it's kind of going to be some do or die time here. I mean, look at CELG. 92.98 was the low here. This is 93, basically a double bottom, and we're kind of tried to rally, failed at the 20, and now kind of getting close to kissing the canvas again. So I'd be a little careful. I think biotech has got a little ways to go in terms of resolving itself. So a major risk gauge is flashing a lot of weakness. Let's get into the markets, shall we? So this chart is very cluttered. These are the real charts I use, I'm aware. Don't be daunted. I'm going to go over it and explain it. This here could be construed as a rounded top. And you can see we had a low here. This is sort of the one bookend. You have the mountain, and then the other bookend here. We had this attempted rally, chop, higher low, and then this was kind of the rally into the end of the year. It's also a lower high that was on a pretty significant move, and ever since then we've been making consistently lower highs and lower lows, and whenever we seem to lose this 204.12, you can see when we lost it here, this is when the real problem started, and we lost it again here, and that's when the problem started. We basically undercut this low slightly, had a reflexive move bounce back to kind of like where the order was before the chaos, and now we're just chopping. I took the liberty, and I often say that the keys, I usually key off of Fed day ranges after we've had moves on the upside or the downside. That played out here when we kind of broke over the Fed. This was the breakout. We lost it, and ever since then we were struggling, and this wound up resolving lower. The Fed day here now in question is here. The high of the day was the 191.56. The low of the day was 187.06. as bearish as Friday was, we didn't lose that low, which I guess you could take a little solace in if you're bullish. The problem I have with that, though, is that you have this Fed day low, basically tweezers, a rally of kind of a false breakout of the Fed day, a bit of a kind of look above and just chop. This is bullish, right? Look at this. You had a look back into the Fed day, the breakout day over the Fed day. This was the Fed day. You had kind of weakness, retesting those lows and then closing, and then basically a breakout of range. This was a bit of a look above, a look into, and just basically closed with equal highs. When you had the gap below the body of this day and you closed below the low of the pullback, that is cautionary. The next day, you had this plunge back down, held the Fed lows again, rallied, again an attempt, and it basically got to the body of the pullback. And then when that failed, we are basically back down kissing the canvas again. We haven't broken yet. If this does break, though, all of these hammers break, I would expect there to be some hemorrhage. The expected move this week is about $4.95. Let's just call it $5. That would mean a move down to 183 down here. I think that if these break, that number will accelerate, and we would likely see these lows and potentially lower. I was saying for a while that I thought we could see primary trend and potentially another reference low in the 173s. So I think a break here might put that into play. The move up would be basically back up to 193, which is kind of like right into this area, the meat of this move. And I think that if you've had this many lows here, that a break of this range in either direction would be quite violent. Like if you took out these lows, I think it would be definitely, I shouldn't say definitely because nothing is definite in the stock market, but look where we're basically holding. The pullback lows of here. We've had multiple attempts here, to break it. We've held. So I think a break of this range will get range extension lower, as do I think a break of this range to the upside would get range extension higher, potentially to the upper end of the channel, and I said really the 61.8. You can see this pattern here is starting to look a lot like this pattern here. You had these multiple tests of the lows, and once they finally broke, you had this follow through and cascade. If these break, you might finally have that follow through and cascade lower. If this is a failure, meaning that all the sellers were wrong and we get a move back up, I think that could also be quite violent and retest the 197s and maybe even the 199 or 200. This to me would be an excellent opportunity to start to try to short the market into, this resistance. That we know this 200 to 202 has been resistance for a while. It had been very key prior support and will likely resist now. So that's sort of what I'm looking for. I'm either looking for a short under these lows or a long back up above these highs. So that's my story. I'm sticking to it. IWM, quite piggish, showing a lot of relative weakness. We could see we're already below this bounce hammer. We're not below the body of the excess here, but we are kind of getting going. Just to go back, there was one thing I wanted to note here on a caveat. This day, while it looks like a big hammer, there's not a lot of excess here. It was only a couple of prints. You could also construe this entire day as excess, but if that were to get reviolated, I think it would be quite bearish. So IWM could be leading the story lower. You can see we have a snap a trend. The rally stopped at the backside of the trend, and now we're losing this hammer low, and we're kind of getting into some dangerous territory. I've said for a while that I thought we would retest at some point the breakout in the market, the 2007 peaks, and that is in the 185s here in terms of IWM. In SPY, that's 157s. So we are quite a ways below there. Above there. The good news, though, is that in SPY we are still while we broke the channel from the 2011 debt ceiling lows. You can see we were in an uptrend for a while, and we basically failed, retested the backside, and now we're coming down. We have not broken the uptrend from the 2009 low connecting to the 2011 kind of bear market low. So I do think that that could, at the very least, be retested. That's also a reference low here. And that, to me, would probably provide some support, as it would in IWM, that might coincide with an actual move down to this 85 level. You can see there's a gap at 84.32, and the breakout is 85.74. I believe, and you can see we tested there, had a quite severe correction, didn't quite get there, pulled back, checked it again, and then finally got off. Once the off to the races, once a breakout is established, usually a retest tends to be a bit of a buy. On the weekly chart, with regard to IWM, however, we are below the trend line from the 2009 low. You can see we broke it, retested it, and now coming down again. That is not a good sign. I wouldn't be really bullish on IWM unless you really take out this 102.98. Let's just call it 103. Anything below there, to me, and you can see the reference low here was 103.54. Anything below that 103.54, in my view, is still weak in IWM. Cautious, for sure. Let's get into the Qs. We don't need to be on such a long time frame, do we? 2 years daily, that's what we've been kind of operating on. The good news for the Qs is that it's been kind of holding up the best, but we are starting to lose these pullback lows. Here we had a pretty powerful rally back up, 61.8, failed, coming back here. Any breach here, to me, could be vulnerable for a move to test the primary trend again. Down in the 90s, we have some reference lows there. We got a little bit below there here on the flash crash, but I always say that these levels get documented and the machines always want to retest them. The good news is we do have a slightly higher high here. This is basically a double top rolling over. Yeah, it's troubling. And anything below this box here, and we are below there, and the body of the pullback low, to me, is a little vulnerable. So I am a little cautious in these stocks. Let's just get to what everyone wants to hear about, the FANG stocks. Oh, before we get to FANG, I want to talk about the equivalents, the FANG equivalents in the regular market, the S&P and the Dow. Look at Disney, double tops, basically a double low here and kind of bear flagging out. Below trend, near flash crash lows. This is, to me, looking a little vulnerable. If you break here, there might be 100% retracement, and we could see, some past levels, maybe even into the 70s. This is not looking very healthy. I'd be very cautious below the 20 MA here. You can see the 20 MA resisted there again. So anything below the 20 on Disney, to me, is still vulnerable. The Nike, that was another major horse leader, looking a little vulnerable. They reported their numbers. The numbers were good, and they went straight down. People used this gap to sell the crap out of this stock. There was a split. It's just been making lower highs since, and about very close to making lower lows. It would not shock me to see a test of trend. Not that far off anymore, particularly if these lows get taken. I think we would retest the trend. That is Nike. This, to me, is maybe one of the most troubling charts in the market today. The head and shoulders top breakdown of Goldman Sachs. We have roughly, with an exception with a little bit of excess, been holding a reference low. I have been expecting there to be some type of a check back up into this breakdown area, which we're starting to get and have not gotten yet. You can see the 20 MA roughly has been some resistance with a couple of little moves and closes above there. You have declining basic moving averages. The 200 is downsloping, the 100 is downsloping, the 50 is downsloping, the 20 is downsloping. You've had the breakdown. There should be some type of a throwback. I would love if it happened near the earnings, basically to the downtrend line. That would set up for a great right or right out type of a short, type of a play. Particularly if it coincided with the gap fill up in here. Maybe it went a little higher than the neckline. I would love somewhere between here and the neckline and the gap fill to start a short attempt at a position. The most horrific chart maybe in the history of stocks right now, or at least what could be troubling, is the Deutsche Bank chart. I've discussed this one many times. We are well below financial crisis lows. Remember, the world was ending here at 21, and we are in a pretty nasty defined, at least the tops, in a down channel. The bottoms aren't as defined, but we could, this is below zero, so I don't know if we're going there. That to me seems a little extreme. I don't think Deutsche Bank is going to be a zero, but I did a survey, and most people thought that this was going to be a sub 10 and a sub 5 stock. They have a huge derivatives book under a ton of pressure with oil and copper weak. These guys got a lot of business from U.S. banks when we had all of our regulation. Deutsche Bank basically soaked up all that, kind of exotics type of business, and they are paying the price for it. You've had some, I would say, multiple standard deviation moves in what people thought possible in oil, and I think that this is what's been reflected in Deutsche Bank. If there's any type of a move back up to these lows, it's probably a good right or right out short opportunity. In the meantime, in the short term, that we do have a little bit of an excess low here, so if you want to try long against 16, you're welcome to. But for me, when stocks start getting ugly like this, I kind of wait for downtrend touches after rallies, and I like to short those. The trend is your friend. When you're in an uptrend, you buy dips. When you're in a downtrend, you sell rips. Kind of simple. It sounds too intuitive, but for a lot of people, it isn't. So after teasing you guys, I will bring you into FANG. This is my actual Facebook chart. It's pretty crazy, right? But it's actually quite accurate. I will show you something that I've told people, and people who listen to me have benefited tremendously. We have a very, very long-term and well-defined progression line. When you are at or below the progression line, Facebook is a buy. When you are above or at the progression line, in the past, Facebook has been a sell. Look up here. Tested above, sold off. Tested above, sold off. Tested above, sold off. Tested above and got to a Fibonacci extension, a big one. I said to people, sell at the 116. I said longer term, it is very possible that we go higher. But in the short term, this would be some problems. Let's take it into modern day. We had a gap above a downtrend line, a rally, got a little bit above the progression line, a little bit above the Fibonacci retrace extension, and now we are below the gap of the earnings day. Oddly, though, this is one of the only FANG stocks, I should say the only FANG stock that held on to its earnings gains at all. We are right at an inflection point. The 50-day moving average has been support here, here, here. When we broke, it got ugly. Here we held, at least for the first time, there should be, quote unquote, should be a bounce back, maybe to 106. That's kind of where the body of this is, so that would make sense. It's also sort of like the upper end of this range. I think that it's possible that this gap fills. We have to be a little bit cautious. 99 was really the big breakout, 99, 100. And then we have some other reference lows around 92.54. So I think a move back down into there will probably be buyable for at least a bounce. Longer term on Facebook, I'm very bullish. They had a quite impressive quarter. They didn't rest on their laurels and make excuses like a lot of other companies complaining about the strong dollar, which we know they've been complaining about in the past. I just think that this is very typical price action. It runs up, goes sideways for a while, which will probably be what happens here. You probably could sell some strangles in this if you're, you want to play it. You could sell the puts into the decline and then the calls into the rally, but probably get one of these. Eventually there'll be some type of a shake, and then it sets up for the buy again, but probably before their earnings. So that is my take on Facebook. I've had quite a good track record in Facebook. That doesn't mean it will be great forever, but it's been working, and until it doesn't, I think I've earned, at least some stripes in terms of some credibility in analyzing Facebook. So that's my thought. Anything around 200 MA has been viable in the past. Let's just hope that we get an opportunity. It sets up again. Amazon. Oh, wow. This stock has come. How the mighty have fallen. We had a look above range, fail. Stock came back down, stopped just shy of the 61.8, rallied ahead of earnings. This was up on Facebook. Woo. This was just really quite bad. We lost a gap and go below this kind of breakout day, and it's just been down ever since. We are below the secondary trend line. Wouldn't surprise me to see 100% retracement down into the 400s. The real primary trend line is quite a bit lower, down in the 300s. I don't know if we're going to go that low, but I hate to say it really wouldn't surprise me. A full round trip of Amazon would be down to the low 300s, 311, 3-year or weekly. You can see this basically has gone quite parabolic. Those moves don't tend to end well. A 61.8 and basically down to this kind of breakout area would be to 442. It's just below here. The real breakout, I would help if I spelled this right. I'll have to make a correction. Was the 408. I think that this could be possible, as crazy as it sounds. We probably will find some support here for some symmetry purposes around the 490. And then have a rally, maybe back into the mid-500s, and then my thinking is it would probably roll over again. If this is going to be a symmetrical pattern, you find support where there was past support, past resistance, you come back down, it just sort of, it all kind of mirrors each other. The moves kind of mirror each other. The primary trend line to me would be a screaming buy. I don't know that we're going to get there, but if we do, it would be a buy. We are getting in the short term a little bit oversold, being below the channel. Oversold can get a little more oversold. Like I said, there are some past lows here in the 490s. It would not surprise me after this steep of a decline for there to be some type of a bounce between the 490s and the 478, which is the kind of the lower end of this distribution. So I do think a little bit lower, but I do think that there will be some type of a tradable bounce coming soon. Another piggish looking stock is Netflix. I took a lot of heat saying that I thought this was a double top. It was right. We are really, actually, I had put some put ratios on this, and I covered a little too early on Friday. We had these two hammers, and once those hammers were lost, I should have known that this low wouldn't hold, but they were the same day expiration. Yep, covered that a little bit too early. That's a little disappointing. Where to now on the Netflix? Another one that did not, this was like Google, actually. They reported the stock was initially up, but then it wound up being lower. We are coming down. The primary trend is down at 63. The breakout was 70. I think that this could be in play. I know nobody is going to want to hear that, particularly if you're long the stock. But I think between 70 and the 63s, like the 63 to 65 level, I don't know where it'll be when it gets there, could set up as a buy. I like put ratios to play for a move down to that area. Look at this. 70 was really key resistance. I mean, we gapped and it was off to the races. I would think that people who missed this entire move would be interested in buying some Netflix down in this area. So I will be a buyer between 70 and like 63 to 65. I don't know that it's going to not bounce before there, and I'm sure I'm going to, but you're a dummy. It rallied. 93.35 was the after hours earnings low there. You can see that coincided with these 93s. So I would think between 93, 96, maybe 100 if you're lucky. That will be resistance now on the upside. I had said for a while I had drawn in some levels, 115, 110, 103.88. all of those levels kind of held. Now we're kind of playing here, and now we're breaking. This is yet another break. It's starting to get steep, which is good. I love when moves get steep, either to the downside or the upside. That's usually when they're kind of coming to their fruition. I know that there were some calls, I forget which firm it was, that said that this stock could see 45, which would coincide with the 2007 top. I don't know if it's coming down that low. I mean, if we're in a really bear market, it's very possible. Maybe we retrace the whole thing, but I don't think that that's playable at this point. I do think that there is a play to be made down here. I will be sitting to buy stock and or to sell out of the money puts. Google, really piggish move. Rallied. This was quite a bit higher above the channel in the after hours, but didn't get their regular trading hours. Let's do a little bit of a trade school here. When a stock opens up regular trading hours and it had been higher on an earnings spike after hours, and the same goes for the move down, we'll discuss that in a second too, but if a stock opens up and it is the regular trading hours high is below the after hours high, meaning this high was below the highs up here, you have to use the opening 5 or 15-minute bar as your guide. Anything above that area, you can stay long. Anything below there, you got a GTFO. And this is what happens. Similarly, if you were to open up, if it was down here after hours and then it opened up here regular trading hours and it took out the first 5 or 15-minute bar, the play would have been to the upside, right? For a rally back up. I think that Google is in a very defined channel. It's kind of spent a lot of time down here. It's now spent a lot of time up here. It might want to traverse down to the lower end of the area and the kind of breakout zones. So I don't know that there's not going to be a bounce first. Things don't usually move in a straight line just like that. Like here, there was a rally and it kind of just took its time to get to the low. So maybe it's like this. Maybe there's a move down, some sideways to up, a move back lower, and just kind of, it could take a while. But I do think that the lower part of the channel could be in play at this point, considering we've spent a lot of time trying to get to the upper parts. Maybe it wants to traverse to the lower. This is the key, 687.78. That was the previous pivot. If we lose there, that was also basically near a gap fill. It's probably going to be a move to the 200. I would say that around here, there's some reference support. That'll probably be a support level. I would be interested in playing put ratios. I just don't know how easy they're going to be to get if you're going to have something like this. I don't know that we're going to have something like that. If this was Priceline, I would think that it would be down here maybe by the next week or two. That's sort of how that stock trades in its channel. But Google tends to be a little bit choppier. You probably could sell strangles in this, believe it or not, and be relatively okay, meaning selling out of the money calls and then selling some out of the money puts. I think that strategy actually would work quite well for the Goog. Apple. Had a little bit of relative strength this week, but looking like a rounded top, lower highs, lower lows. We basically have held the flash crash low, though. I have been looking for a move to the primary trend line, which would be amazing if it coincided with this 85. The longer it takes to get there, the better the chances of that being the case. That is the big 61.8 for the entire run in Apple, from the low to this high, and that to me would be an interesting level. If that breaks, we could see a complete traverse to the 73 to 75-ish level. That would take back the entire run in Apple. That to me would be a good area to sell some out of the money puts and or to get long. So what I'll probably do is, if we can get to 85, sell some out of the money puts down here, maybe some longer dated ones, and then not freak out if it actually gets there. I could put the stock. If it bounces here, hey, I never get it put to me, and I get to keep the premium on the short puts. If it gets down to here, I won't be in full panic mode because I know that we're at an important reference low. Priceline. Snap, the up channel, is basically coming down to this 990 reference low. I really would have liked it to have gotten there before their earnings, maybe even taken it out to have set up for a long, We are, though, below the trend, and this, to me, is going to be a really big right or right out number. I wish these guys would just split their effing stock already. It's really annoying, to trade this. You can imagine, it's not so easy to trade $1,000 stock. Google has split, Apple split, Netflix split, Amazon in the past has had splits. I just don't get why these guys can't split their damn stock. Very annoying. 990 is the key. If you lose there, let's go into a weekly. You can see there's not that much support here. The problem would be is you would probably want to traverse down to this breakout area, which was in the 770s, and potentially even go lower. So this is pretty do or die. You're on a 200-week moving average, you're below trend, and you have 100% retracement here. So it probably holds short term. The stochastics are starting to get bombed out. I mean, if this has some type of a big gap down, like $100 or so gap down, probably initially, just because it's been down a lot, can sell some out of the money puts, but it's bearish to me that we held the 200 here, and now we're retesting it with a failed test of the backside of the trend line. So this is really going to be do or die here. That's my view on price line. I think we could end there. I did mention Tesla before. I'm looking for a bounce play in there. We're on a 200-week moving average at a channel low, so maybe this will give some support. If it doesn't, just GTFO, there would be probably significantly more downside to go. It's disturbing that we have held here once, twice, 3 times was not a charm. So I don't know that the all-time top in Tesla is in, although it may be. And this is, like I said, do or die here at the channel low. So that's where I'm going to leave it. We're coming into the earnings call. We are down into that call at a channel low. I would think that the safer play is a defined risk trade for a bounce. I'll leave it at that. Anyway, that's my story. I'm sticking to it. If we rally ahead of there, it gets a little more iffy. I'd actually like to see more weakness ahead of the number. So we'll leave it there. Anyway, if you're not following me, my handle is @JustinPulitzer on Twitter. If you like this video, please subscribe to my channel. It will save you so much time. You will get notifications when I post new videos for weekend review videos like these, Periscope rebroadcasts, and special edition videos. And be sure to hit the like button. That's the little thumbs up below the video. And please leave me some comments. Your comments help me make these videos better. That's that. Anyway, enjoy the Super Bowl, and I will be on the stream this week. Cheers.